Welcome back to another installation of What Are the Odds? I thought, given last week's numbers, it might be helpful to take a little bit of a deeper dive into the employment numbers, such as ones we saw last week. Now, we have two primary economic reports that are used to measure employment. We have the non-farm payrolls and we have the unemployment rates. Non-farm payrolls reflects short-term job market growth. It's more of an immediate sensitive indicator. The unemployment rate represents long-term trends. So, for example, an increase of 150 to 200,000 in the non-farm payroll indicates the economy is strong or it's improving. And on the same note, if the economy is improving, we would expect that unemployment rate to go down. Unemployment rate goes down as a non-farm payroll goes up. That's in a strong market. The opposite also holds true. In a weak economy, we'd expect to see non-farm payroll go down and the unemployment rate go up. Now, when the economy is weak, for example, non-farm payrolls turn negative before the unemployment rate rises. We typically see the non-farm payroll number move first, and then the unemployment rate will catch up. The source, by the way, where we got this information is listed below. If you want to pause the video and take a look at that website for yourself, please feel free to do so. Now, taking a look on the left-hand side of the chart, the red line is the unemployment rate, and it shows a steady decline to the downside. The most recent report was last week at a level of 3.5%. The prior number before that was 3.7%. The blue line represents a non-farm payroll. Last week was reported at 263,000. We can see over the past several months, the non-farm payroll has continued to move to the downside. You'll notice this doesn't really make a lot of sense because when the non-farm payroll goes down, we would expect the unemployment rate to go up. But they're both moving down, which just tells us non-farm payroll is weakening, but the unemployment number has not caught up yet to the data. Now, the right-hand side shows us the correlation between the two. Now, a positive correlation occurs when both numbers in the data set are moving in the same direction. A perfect correlation is when both numbers move up exactly the same amount. And a negative number on the correlation indicates numbers are moving opposite of one another. Now, in a normal situation, we would expect a negative correlation. Unemployment down, non-farm payroll up. We can see, and this measures going back 1 year. So the 12 prior reports, we see a correlation of 70%. 70% of the time, these numbers have actually moved in somewhat the same direction. And this is obviously something that doesn't, on the surface, make sense. But then when we take a deeper dive into how the numbers are calculated, again, non-farm payrolls reacts first. The unemployment rate will start to act as we believe it will behave, but over a longer period of time. So we have a 70% correlation as both numbers are trending lower. Now, taking a look at the data from a little bit of a longer-term perspective, this goes back to 2015. We have a 1-year correlation, that's the blue line, and the red line is the S&P 500. Now, notice a big turn to the downside. That was in March of 2020. That was a huge market sell-off we saw at that time. At that time, the non-farm payroll number collapsed and unemployment went up very, very sharply. So the correlation, the blue line, went to nearly negative 100%. Not exactly 100, but very close to that. And that makes sense. Non-farm payroll went down very quickly. Unemployment rate went up very quickly. But more recently, we can see as the S&P 500 hit a high and now has started to turn to the downside, the non-farm payroll has weakened, but the unemployment rate has not yet gone up. And that's why we see a divergence, a disagreement between those two numbers. Now, taking a look at the 90-day forward performance, how does a market typically behave 90 days or 3 months out from when we look at the correlation? So we would see all the way to the right-hand side, we have a negative 90% correlation that represents the best returns. It averages, and this is the maximum amount of money we could make. We could make a maximum of 13% in the next 90 days when we see a non-farm payroll unemployment correlation of near negative 90%. But keep in mind, this particular case, that is attributed to the 90% correlation that took place March of 2020 when the stock market just completely collapsed all at once. This was the only time, at least going back 7 years or so, that we saw a 90% correlation. So that's what this bar on all the way in the right hand side reflects. Take that out of the consideration, for example. The second best number is a 60% negative correlation, and that's a maximum return of 10% return on your money in 90 days when we see a 60% negative correlation. And we see that took place. We have over here a 50% correlation going back to May of 2018. We have a 52% correlation more recently, March of 2021. Now, this measures 50 to 60%, so that's why it says 60%. It's actually that bracket between 50 and 60%. So point being is that when we have deep negative correlations, we tend to see the best returns over the long term, the best 90-day returns over the long term. Keep in mind also, we're taking a look at the past 7 years, and this reflects, for the most part, uptrending markets when we have negative correlation. So this is not to say it holds true for 100 years, but this is a survey we looked at, which is quite a bit of data, around 7 years or so. Now, this is the 90-day maximum performance that we can expect when we have a combination of the non-farm payroll and unemployment reports that are released and how they're reported respectively. So, for example, if we take a look at this grid, we have an improvement in the non-farm payroll. At the same time, the unemployment rate goes higher. That would be a divergence because we'd expect one to go up and one to go down. We only see historically around 3% over the next 90 days. When we have the non-farm payroll improves and the unemployment is lower, that's the ideal situation. We see historically the best results. Again, when the non-farm payroll goes up and unemployment rate goes down. When the non-farm payroll goes up and the unemployment rate remains unchanged, and oftentimes it is unchanged, then we see an average of a 4% return on your money in the next 90 days. When the non-farm payroll declines, like we saw this past report, and at the same time the unemployment rate also goes lower, that's a 4% return on your money. When the non-farm payroll goes down and the unemployment goes up, that's around 5%, and a 3% return for a declining non-farm payroll and an unemployment that remains unchanged. Point being, ideally what we want to see is a 6% return historically over the next 90 days when the non-farm payroll is better than expected. Or, I'm sorry, not better than expected, but when it improves over the last quarter, or I'm sorry, the last month, and at the same time the unemployment rate goes down, which is also an improvement. When both numbers improve, unemployment down, non-farm payroll up, that tends to produce the best results. The worst results occur when the non-farm payroll goes up, but the unemployment also goes up. Or when the non-farm payroll goes down and the unemployment remains unchanged. Or even when the unemployment decreases. So point being, if we see convergence or agreement between these two numbers, both pointing to stronger economies, then we tend to see the best returns. Now we can take a look at the most recent, over 7 years, the trend in the non-farm payroll. Now what we did is we took a look, for example, the blue line shows us the last 3 reports. And we want to see the last 3 reports. Did the number go up or down? Was it an improvement or a decline? If it improved 3 times over the last 3 months, that would be a 100% score. Over here, we can see the blue line at the very top is almost 70%, around 66%. That means 2 out of the last 3 reports were an improvement. And obviously, most recently, we don't see that. We actually have a 33% result. Only 1 of the last 3 reports was an improvement. The orange line represents a 6-month trend, meaning out of the last 6 reports, how many were good. And that 6-month trend is also not so good at all, around 33%. And the green line shows the 1 year. Over the past 12 reports, how many reports were good how many were not. And that's also not so great either. The black line shows us the S&P 500. Notice something interesting. As the S&P 500 went up, up, and up, and up over here, the blue line really spiked higher. That shows us in the month of July, the last three reports all showed an improvement. Maybe this is a little case of buying the rumor, selling the news, meaning traders and investors were already buying stocks based on the anticipation of good economic numbers. And maybe this is the type of thing, buying the rumor, selling the news. If we see a lot of good reports, maybe we should, trade to the contrary. That's just one, food for thought. And we could also, take a look at the other side. We say, well, when the last three reports were all, misses, maybe that's a good time to buy stocks because we can see the stock market actually going up quite a bit after that. So we should take that in consideration. The market's a forward-looking mechanism. It's always trying to guess the next step. And we should take a look at the trend of the numbers to see if the market's already factored in that potential good or bad news, or is it really a surprise? We hope this has been helpful. We look forward to seeing you back soon.